Rivian has closed the $6.6 billion loan, or at least the first tranche of that loan, from the US Department of Energy. This is really huge news for the company as they try to build out their second factory that's going to be in Georgia. After that's completed, 400,000 units of R2 and R3 vehicles potentially coming out of Georgia. But there's a lot to this story. There's the funding of the business. There's also how does Rivian get to profitability? Even after this, even after they get to 615,000 units of capacity, it's going to be hard for Rivian to get to profitability. I'm going to go through the details of this loan because it is a loan. It's not a grant. It's not a gift. And on top of that, I'm going to show you a very simple model to just give you an idea of what Rivian's economics look like and where they need to improve to get to cash flow positive. That's what they have to get to. This is an automaker. This is a manufacturing company. They should not be valued like a tech company. They should be valued like the manufacturer that they are. And as a result, we need to see a return on this $6.6 billion. So I'm going to dig through all that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing, and be sure to check out asymmetric-investing.com for my newsletter where I share my market-beating portfolio over about the past year. It's about doubling the performance of the S&P 500. You can see what I'm buying every single month and updates on that portfolio on a weekly basis. Tons of analysis and research, deep dives into high growth companies. I'm looking for stocks with 10x potential over the next 10 years. So check that out if you're interested in more. Now I'm going to be back with all of the details about Rivian and about their future cash flow in just 1 minute. All right, if you are serious about investing, you need to know about public.com. That's where you can invest in everything from stocks to options, bonds, and even crypto. They even offer some of the highest yields in the industry, like the bond accounts, 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools that you need to make informed investment decisions. Like their built-in AI called Alpha, it doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Now, Public is a FINRA registered, SIPC insured, US-based company with customer support teams that actually care. The bottom line, your investments deserve a platform that takes them as seriously as you do. You can fund an account in 5 minutes or less at public.com/ASYM and get up to $10,000 when you transfer in an old portfolio. That's public.com/ASYM. This ad was paid for by Public Investing. Full disclosure is in the video description. This is the shareholder letter that Rivian put out. This kind of gives a nice look. I'll show you the 8K as well, but this is the land that they're going to be building the plant in Georgia. And this gives some of the details. This is really a $6 billion loan, but then $600 million worth of capitalized interest. That's going to be interest that typically gets capitalized during the construction process. So basically there's no cash flow coming into a business when you're doing some sort of construction. This is typical with commercial construction or even building a house. But the total number that Rivian is going to have to pay back is $6.6 billion. At the end of the day, 2 tranches of 200,000 units is what they're going to be building. So in total, 400,000 units of capacity. I'm going to use this throughout. So remember those numbers, the $6.6 billion numbers. I'll get to the tranche details. But then the 200,000 units and 2 of those tranches and 2 of those blocks to get to 400,000 units added. That's in addition to the 215,000 units of capacity that they have in Normal, Illinois. The structure is a little bit convoluted, but the borrower is technically Rivian New Horizon. The sponsor is Rivian Automotive. They are mentioning a couple of newly formed entities. So I did go back and just confirm Rivian Automotive Inc. That is the parent company. So that is the sponsor. That is who is going to be guaranteeing the loan. The guarantors right here. Basically what they're carving out here is the IP and the deal with Rivian, and the deal that they have with Volkswagen. So they have that 50-50 joint venture. That's not going to be a guarantor to this deal. That would be because Volkswagen doesn't want to have to be a guarantor for this $6.6 billion loan. So that's why that makes sense. That's why the structure looks like this. There's an image in just a second that I'll show, but here's the 2 block sizes. $3.35 billion for the first block, $2.62 billion for the second block. There is interest, but not a lot of interest because this is a government loan, so they're going to get basically the treasury equivalent yield. The other thing to keep in mind, there is collateral, and the collateral is all of the assets of the borrower, including all project assets, inventory, and receivables, fixed assets of the guarantors, so everything that Rivian Inc. owns, and all equity interests owned by the borrower and the guarantors. That means basically Rivian is entirely on the hook for this loan. This is just like taking out a loan from the bank. You just get a little bit better interest rate. Here's that transaction structure. Like I said, a little bit convoluted, but the DOE loan proceeds go to Rivian New Horizon. That is going to be the operator of the plant in Georgia and the borrower of the DOE loan. This is where it gets weird. That company is actually going to sell the finished vehicle at an MSRP discount to Rivian LLC, the sales co. And then that company is going to actually sell the product to the end customer. But all of these things are owned by the sponsor, Rivian, and they're all guarantors on the loan itself. So this stuff doesn't really matter for us as public investors, but it just shows how convoluted, and this is why these deals would get pretty complicated over time. Here's the actual 8K, the SEC filing. Not a lot of new information in this one, but it does give a little bit more details. The principal amount of the first block is actually a 15-year term loan, and the aggregate principal is $3.355410861 billion. The second block is a 10-year term loan with aggregate principal, again, $2.62 billion. So that's what Rivian's getting from a funding perspective. And they're going to be building the R2. That's this vehicle right here. The R2 is expected to begin production in 2026. Started at about $45,000. The R3 is this vehicle, a little bit smaller. We don't have a ton of details on this one, but I would expect that closer to the end of the decade. So now the question is, how does Rivian take this money, invest it into Georgia, build a plant that's going to build more vehicles, and be able to get to profitability? That's really the fundamental question that investors should be asking themselves today. So I built a simple model to show exactly how the company could potentially do this and how it could run into problems. Now, I don't typically build models because the only thing we know about financial models is that they're wrong. But when I do, I make them very simple because the simpler they are, the easier they are to understand, and the easier it is to see if a company is moving in the right direction with the big things that really matter. So let's start with what we know and then build in some assumptions based on what we've learned over the past few months and this loan as well. So the first thing is this is the current cash on the balance sheet. $9.4 billion in cash was the end of the third quarter. What I've done in this 2024 column is estimate what all of 2024 is going to look like. And basically that just allows me to build the rest of the model to the right. Like the operating expense number is going to be about that for the foreseeable future. I'll just show this chart right here. You can see that operating expenses, $3.6 billion. Maybe that goes up, maybe that goes down a little bit in the future, but I think that's probably a pretty good proxy to assume for operating expenses in the future. They are going to spend about $1 billion in capital expenditures. They did say that. Gross profit I have is negative $1.39 billion. This is basically what it would be if the company's gross profit break even in the fourth quarter as they expect. So that's how I got to all of these numbers. This is the actual delivery number for Q4 or for all of 2024. The cash number. This takes the cash that it was currently on the balance sheet at the end of the third quarter, adds in $1.3 billion from Volkswagen in November 2024, minus $1 billion for operating expenses and capital expenditures. That's going to be about accurate for the fourth quarter. And then adds in the $3.355 billion that came from this DOE loan. That would be likely right around where cash ends at the end of 2024. Now, I do want to note that this is also likely what debt is going to end up as. The $5.468 billion number is what was on the balance sheet at the end of the third quarter. $1 billion of that was going to Volkswagen. That was convertible debt that they gave their initial investment. That is going to convert into equity. Add in the $3.355 billion in debt to the government, and now you have $7.8 billion worth of debt. This would be probably about where we end up at the end of the first quarter of 2025. Deliveries. We don't know what deliveries are going to be. They haven't given us guidance yet, but I think 75,000 units, and they are not going to be delivering anything with R2 or R3 yet. Now I have my price assumptions here. We can change these in just a second when I build out this full model, but I have $90,000 for the average R1 price, and I have $50,000 for the average R2 price. This R1 number currently is a little bit higher than that. It's closer to $100,000. But I think over time, we'll probably see that start to come down as competition comes into the market. These become a little bit more people not buying all of the bells and whistles. So that gets you to revenue of 6.75 billion. Gross margin, I'm assuming this is going to get better over time, but I'm not going to get too optimistic. Again, this is something that we can maybe change to see if we can get to free cash flow positive a little bit more quickly. But that gets you to a gross profit number of negative 1.35 billion. Again, operating expenses I have kept flat. CapEx 1.5 billion. That is assuming that basically half of each of these tranches happens over the next 4 years. So this is something I will keep consistent through 2026, 27, and 28. That gets you this negative free cash flow of $6.5 billion for next year. Now let's add in 2026. 75,000 units in 2026. We start the year with $6.6 billion worth of cash. We don't have that second tranche yet. I will add that next year. But you start the year with $6.6 billion in cash. You're going to sell 75,000 units and 140,000 units. The reason that this one is important is look at this sum right down here in the bottom right, 215,000 units. This is the capacity in Normal, Illinois. So this is running full steam in Normal, Illinois. Not clear if they can do that, but this is what we're building into the model, giving them the benefit of the doubt. I'm also not assuming that anything is coming out of Georgia in 2026. I think that's overly optimistic. We'll just start with 2027 there. That gets you to $13.8 billion in revenue. I'm assuming a 0% gross margin. I think, again, that's probably optimistic, but that's break even on a gross profit basis. Operating expenses and CapEx. Talked about those a little bit earlier. That means you are burning through $5.1 billion in free cash flow. You're getting really tight by the end of 2026. Beginning of 2027, again, you're sitting here with $1.5 billion in cash. But now production goes up to 75,000 R1s, and I've just added 100,000, so half of the capacity of the first block in Georgia, 240,000 units at 50,000. That gets you to $18.8 billion in revenue. Now I've gone up to a 10% gross margin. Now, I know Rivian has talked a long time about being at a 25% gross margin. Guess what? That's not going to happen. I will show some gross margins here of auto companies. None of these companies are generating a 25% gross margin. The one company that is generating a 25% plus gross margin is Ferrari. Rivian is not Ferrari. So let's not get overly optimistic with the gross margin number. 10% solid gross margin by 2027. That gets you a gross profit of $1.9 billion. Again, same operating and CapEx numbers. That gets you to a negative free cash flow of $3.2 billion. So we're still burning a ton of cash. And this is 3 years from now. Now in 2028, I added in the $2.62 billion tranche for the second block in Georgia. That gets you to positive cash, and now you're adding in the full 200,000 units of production for R2 or R3s in Georgia. That gets you to a total of 415,000 units produced, $24 billion in revenue, 15% gross margin. But again, even with a nice gross profit, you're still not covering your operating expenses and your CapEx. You have negative free cash flow of $1.5 billion. Let's go out to 2029 and 2030. Again, these are the cash levels at the beginning of the year. And I'm just taking this cash level and subtracting the cash that has been burned in the year before. That gets you to, you're already at a negative cash position by the beginning of 2029, even after this $6.6 billion loan from the government. Now, again, I go up to 440,000, now 540,000 units of production. In total, 615,000 units of production. You can see that in the bottom right. Even at a 15% margin, gross profit of $5 billion, you are still at a negative free cash flow of $38 million. Basically break even once you get to full production. This is fundamentally the challenge that Rivian has, is that even at full production, they may not be able to get to profitability. So how could you improve this? How could you get this number to be positive? Well, you could go to a 20% margin. You could say, you know what, I want to have operating expenses instead of 3.6 billion be 2.5 billion. Now you've got to answer, what in the world are you going to cut? Maybe some of those costs somewhere in this range go to Volkswagen. Maybe that business starts to take some of their operating expenses. Maybe it becomes a profit center. So that's a possibility, definitely a possibility. We could even take this number and back it out starting in 2025. That really changes the cash story. You don't have a ton of cash on the balance sheet, but now you at least have $4 billion in cash on the balance sheet going into 2030, and you have a profitable business. You could also say, you know what, we're not going to have $1.5 billion in capital expenditures. We're only going to have $1 billion in maintenance CapEx per year. $3.3 billion in positive free cash flow at that point. Now, I think there's a couple of things that are optimistic. One, the R1 price at $90,000, that may be a little optimistic. R2 price average $50,000, also likely optimistic. This number, I think, is crazy optimistic. I think really you should be looking for a gross profit of more like 13, 14, 15%. That's where we've seen Tesla kind of settle in. I also think operating expenses. If you're going to grow the business this much, you're not going to be able to cut operating expenses from where you are when there was 51,000 vehicles being produced in a year. But let's say that this is where we are. So now we have $4 billion on the balance sheet. We have $3.3 billion worth of cash being generated per year. But guess what? We also have $10.4 billion worth of debt. I'm not even going to add these into the model because these things will be adjusted. They will issue equity. Something will happen to pay this off. But 2026, there's $1.25 billion worth of debt that is going to be maturing. 2029, you have another $1.5 billion. 2030, $1.725 billion. The government debt is not going to be coming due until the mid to end of the 2030s. But that debt is coming due. So something is going to need to happen. And if the company isn't able to get to positive free cash flow even faster, they could burn through all their cash like I had earlier in this model. Let's also do a reality check. This is something I think we always need to do with investments. Even if I build a simple model like this, are these numbers reasonable? Is it reasonable to say that Rivian is going to be able to sell 500,000 R2 and R3 vehicles? Well, let's look at what GM is selling. This is their most recent report from the fourth quarter. Also has the full year numbers for 2024 right here. So 500,000 units. That would be everything that GMC sells, basically. That would be almost as many sales as all Silverados combined. Here's an interesting one. They sell over 200,000 Trax, Chevy Trax vehicles. That could be a good proxy for something like the R3. These are Ford's numbers. So SUVs, overall in 2024, they sold 876,000 SUVs. We're talking about Rivian selling 615,000 SUVs, so almost as many as Ford. Now, there's no doubt that this loan is good for Rivian. They need the funds. They need to be able to build this Georgia plant, or there's literally no chance that they're going to be able to survive as a company because with 215,000 units of production, there's just not enough production to get to cash flow positive. The challenge for Rivian is they're still an upstart. They have not shown that they can generate positive margins. We don't even know what the demand is going to be for their vehicles once they reach some sort of level of higher scale of production. Producing 50,000 vehicles a year is one thing. There can be a certain level of demand for vehicles at that price point. But once you get to making hundreds of thousands of vehicles, now you're no longer a niche product. It's no longer the coolest vehicle on the street. Now you're just another vehicle and you're competing with everybody else on all the things that people are looking at when you look at vehicles. Is the size of the vehicle right for me? Is the range right for me? Is the price point right? What's the financing look like? This is all the things that Tesla has now started to deal with over the past couple of years as they become a scaled automaker. And the numbers are not as good as you might think. Tesla's operating margins are very similar to General Motors and Ford. Is there any reason to think that Rivian is going to be any different? I really don't think so. And we just simply don't know what the demand for their vehicles is going to look like. All of that said, the market is pricing this company as if it's going to be extremely profitable in the future. The best case scenario is that they're going to have a couple of $1 billion in cash flow in 2030, but investors are already paying for that cash flow now. The market cap, after all the dilution from the Volkswagen investments, there have been 2 tranches of that investment, puts the company's market cap today at close to $20 billion. Add on top of that the $10 billion worth of debt, and you have a $30 billion market cap company. That means that the potential, the best case scenario, is you get to $3 billion in free cash flow in 2030. You're already paying for that enterprise value. You can buy any of the major legacy automakers today who are, by the way, are growing, are making more electric vehicles than Rivian is for a lower multiple than this theoretical production that Rivian could maybe get to 5 or 6 years from now. That's, I think, the real challenge, is that there's a lot to go that's going to happen between now and then. And it's not really clear that Rivian is a company that's going to be able to execute very well. Remember, they were supposed to be at scale with the R1 vehicles by now. They're not. They have not executed well. Indication do we have that they're going to do better in the future? I just simply don't see it. So I'm going to be staying out of the stock. I would like to see Rivian succeed as a company. I think they make a nice vehicle. I would like to see those prices come down, competition improve in the electric vehicle space. But as far as an investment goes, not one that I'm going to be making at this point. But let me know what you think about Rivian, their prospects, and what would you change in that cash flow model? I'm curious to hear how you think that they could actually operate differently. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing and check out Asymmetric Investing, my newsletter. So link to that below, and it's been on the screen as well. Thanks for watching, everybody. See you here next time.